Hello there. Thank you for joining me for this presentation on discover the strategies for managing risks in options trading. And my name is Lubosi Forex, as you can see right here. Now, I'm using this new online software for making slides. So I hope you will enjoy this presentation. This is just to make it a bit more entertaining and make it a bit more professional, make it more entertaining and make it look good. So, my name's Lubose Forex, as you can see right here. And I'd love to welcome you to this presentation. And at the end of this presentation, I am going to give you a demonstration of the rocket booster strategy. Now, allow me to thank my mentors. I'd love to thank Robert Kiyosaki, who wrote the book Rich Dad Poor Dad. I would also love to thank Matthew Crater, who wrote the book Rocket Stocks. And I'd love to thank Timothy Sykes, who wrote the foreword to the book of the Penny Stock Course. And you can find all their books on Amazon Kindle. So let's get into this presentation. Discover the strategies for managing risks in options trading. Now, options trading can be lucrative, but it also involves risk. So this presentation is basically just about learning how to manage the risks and protect your investments. And then at the end of the presentation, I'm going to give you a demonstration of the rocket booster strategy. So let's get into the meat of the presentation. Now, remember these 3 points when understanding options trading. So let's try to understand what options trading is. So what are options? Well, options are financial derivatives that give traders the right to buy or sell an asset at specific price within a specified time period. So basically, the time period could be within 1 week or 2 weeks. But ideally, depending with the broker that you're using, basically it's like a month or 2 weeks. Number two, derivatives and their purposes. So options are derivatives because the value is derived from an underlying asset. All right. So an option is basically it's not the exact price. All right. So you are taking a position, a smaller position on the price of the actual asset. Number third thing to understand about options trading is there are two. There are core options and they also put options. So core options give traders the right to buy an asset. All right. And then put options give them the right to sell an asset. Okay. Risk management in options trading. All right. These are the this is what we were discovering, right? Top four things to remember, right? Top four things to discover, right? So, as you can see from the screen, you need to know the importance of risk management. You need to know setting risk parameters. You need to know what diversification is, and you need to know hedging strategies. So let's go through number one. So proper risk management is crucial in options trading. Again, you really need a good risk management strategy when you are doing options trading. Number two, you need to set risk parameters. Now, determine risk tolerance levels and establish guidelines to limit trading exposure and safeguard against excessive losses. Look, it's very much important to have risk parameters. Okay, you need to know. Okay, in each trade before you go in, how much can you afford to lose? So within yourself, you need to measure it. You need to tell yourself, okay, I can only afford to lose a certain amount. All right. So basically, you're just telling yourself how much you are willing to lose. You tell yourself, okay, I'm only willing to lose this amount. Number three, diversification. Spread investments across different assets or sectors to reduce the impact of single. Now, Spreading investments, the way I could describe this point, all right, let me break this point down. Basically, you need to develop a strategy that can allow you to either whether the market goes up or down. So think of diversification in the sense of it doesn't matter what sector you are in, your strategy should be able to make you enter put options or call options. Call options when the market is going up, put options when the market is going down. And then the number four thing we should remember about risk management in options trading is using hedging techniques such as buying put options and selling call options to offset potential losses. Now, basically, the way the way I could put it is there are times whereby we call them reversals. Okay, they are called reversals. So basically, when the price of an asset is cheap, you buy it. All right, and that's what this means here when they say such as buying put options. All right, so that when the price when the price of an asset has crashed, okay, and I'm going to show you a demonstration of what this means at the end of this video, of what it means when they say buying put options and selling call options. So selling call option is basically when the price of an asset rises while it is in a downtrend, you sell. When the price of an asset drops while it's in an uptrend, you buy. That's what this means here. That's what hedging strategies means. And I'm going to show you an example at the end of this presentation. Now, common risks in options trading. So, number one, you need to know that there is a market risk. Now, there are fluctuations in the overall market, and that can impact the value of options. Now, you need to know that these top three, the top three common risks in options trading. You need to know these top three common risks uh, in options trading. All right. So, number one, there is market risk. Number two, there's volatility risk. Number three, there's a time decay risk. So, let's go into what number one is. Now, the fluctuations in the overall market can impact the value. So, you need to manage, you need to prepare for that market risk. Number two, the changes in market volatility can affect options prices. All right. So, I can basically the price can either go up or down. And so when you're entering a trade, have this in mind. You should have this in mind. There is a risk level. Okay, you will lose. Your position will not be positive, it will be negative more times than not. Time decay risk. As options approach the expiration date, their value may decline, leading to losses. So when you are entering an option trading strategy, it's not you're not holding for a long period of time. So you need to develop a strategy that allows you to be get in and out before the option expires, right? So your strategy should have an expiration, it should have an exit, all right? Because every options contract decays in time, and that is very important to remember that an options strategy decays in time. Okay, what do we have here? Did we miss a step? Oh, no, we did not miss a step. Okay. Strategies for managing risk. All right. So we have four strategies right here to help us with managing risk. So the first strategy is stop loss orders. So you can implement stop loss orders to automatically sell options positions at a predetermined price to limit losses. So in the beginning, you could do stop loss orders, especially when you are testing a strategy and you're not sure. You could use stop loss orders, but when you become a professional, you you kind of know your risk level. But in the beginning, as a beginner, definitely take advantage of stop loss orders. Number two, position sizing. You need to calculate the appropriate size for each position. So basically, how much are you willing to risk? So let's say you open a $1,000 account. You can tell yourself, from this $1,000 account, I am only willing to risk $100. So basically, you are telling yourself how much you are willing to risk in that market. And then portfolio allocation, distribute investments across various assets. All right, so again, with portfolio allocation, basically the way I could explain this is, you need, again, it comes back to your strategy. You need to develop a strategy that allows you to trade across markets. Now, some people decide to stick to one specific market. Like, for example, some people say, look, I'm just going to stick to 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 tech stocks. All right, some people just, look, I'm just going to stick to tech stocks. This is what I am used to, and this is what I love. So again, it's all about strategy. Using option spreads. Now, employ option spreads such as vertical spreads or ion condoms. All right, so now, this again, it comes back to strategy. All right. So when you are trading, there are two types of strategies. All right. So there is trading using the trend, and then trading using the range. All right. So you need to know what strategy you want to start with. Later on, as you become experienced, you will be able to trade the trend, and you will be able to trade the range. All right, so that's what this means when it says using options spreads. Okay, and I hope the new presentation format. All right, so case studies. So the first thing is examples of risk management in options trading. So you need to explore real life examples where risk management strategies successfully protected investments and minimized losses. All right, so as you advance, okay, you really, really, really need to look for examples of risk management in options trading strategy. Ideally, you can even search on Google for case studies. All right, you can Google these case studies, you can use YouTube. So, lessons learned from successful risk management. So, you need to understand the key takeaways from the case studies and then apply them to your own option trading strategies. So, look for mentors, look at how they managed their risk, and also you need to be willing to fail. And then the next steps for implementing risk management strategies: take actionable steps to integrate effective risk management into your options trading. So basically what this means is, you need to run a small experiment. Okay, maybe have a small amount that you're willing to lose. Go out there, take actions, learn from others, risk management strategies, watch YouTube videos, follow mentors. And that's why in the beginning I said I have mentors. All right, I did not do it alone. So develop your own case studies that you can master. And in due time, as you keep doing this over and over again, you have case studies, historical performances on yourself, on how to implement these trading strategies. And now we're going to conclude before the demonstration. So, in conclusion, you need to recap the key points, summarize the main concepts of risk management. So, again, feel free to go back in the video to understand the key points of risk management. You can rewind this video, and that's the perfect way to learn. You can rewatch this video to recap the key points of the main concepts of risk management. Now, the importance of risk management in options trading. So, highlight the essential role of risk management and safeguard your investments. You need to protect your investments. All right, you need to protect your capital. All right, you need to protect your capital. Try your best. Always remember to protect your capital, safeguard your capital with your life. And next, steps for implementing risk management strategies. Remember, you need case studies, all right? You need to go out there, you need to test. And the good thing about TradingView, which is the platform I am using to record this video, is they do offer paper trading accounts, all right? So you can build your own case studies using paper trading account. And now I am going to show you the stock that I feel is a good buy. Now, as you can see here, we're looking at Visa. Now, notice that it has kind of crashed here. This is more like a crash, like a seller's wall here. And also notice that there was a it did double bottom in September, and in October it did give us a very good double bottom. This is commonly referred to as the Buffett indicator. During this time was when the Dow Jones crashed. There was a market crash last week, and I'm sorry if you bought during this time. This was the worst time to buy. I'm so sorry. You shouldn't have bought here. There was a correction basically in the market. And after the correction, we have an entry right here. And pre-market, it looks like it's going to go up. And this strategy basically does follow the rocket booster strategy. So again, in the rocket booster, it's very, very easy. All right, the strategy is very easy. The price has to be above the 50-day moving average, which is represented by this blue line here. And then the price also has to be above the 200-day moving average. All right, so the price has to be above the 200-day moving average, and then the 50-day moving average should cross above the 200-day moving average, which is represented by this buy signal here. From the 50-day moving average, cross the 200-day moving average, and then it is a good buy. Okay, and now remember, be careful. Oh, we're talking about risk management. So please, please, please be careful before you buy or sell anything. Do your own research before you buy or sell anything. Do your own research. That's my disclaimer for this video. I reserve the right to be wrong. Do your own research before you buy or sell anything. I would love to thank you so much for watching this video. If you really enjoyed this content, please rocket post it. And thank you again for watching. Feel free to rewatch this video to learn more about the rocket booster strategy. Repetition is the art of learning. I would love to thank you so much for watching. Take care and bye bye.